Hello students, I am Preeti Garg, your tutor for the subject of financial management. Today I am going to cover your first topic of the syllabus of module 1, that is framework of financial decision making. Before coming to the topic straightforward, I would like to discuss with you first thing, what is finance? In a layman's language, when we talk about finance, we think of money or the procurement. Other fellow will say procurement of fund, whereas the third fellow will say it is nothing but best utilization of available funds. Whereas if I define it in terms of finance, we call it as a lifeblood of any business, because finance is such a thing without which we cannot dream even a single endeavor of the business or even our day-to-day life. So finance is defined as a lifeblood of business. Whether you are to think of any management function, you are needing the finance. So it is the most important function of the every business organization. And or in other words, it is also called, it is a pivot around which the whole business organization rotates. We cannot think, even whether you are to think of planning, production or human resource management, you all needs funds for the running of the business smoothly. Now coming to the financial management. What is financial management? It is mainly concerned with the proper management of funds, or we can say it cannot be recognized only up to the proper management of funds of the utilization point of view. It is defined by the Mr. Solomon as financial management is concerned with the efficient use of economic resources. So in simple language, financial management can be defined as planning, organizing, directing and controlling of financial activities of any business organization. We cannot think of any business which can be run without the use of finance. Whether it is production or it is marketing or accounting or management, they all need finance in one or the other term. If you are to start up the production thing, first of all you need machinery and the building. For that you need to have funds. Then only you can think of fixing up of the machinery or the any other business activity you plan for. Even if you want to go for project management thing, you are defined to decide on different projects. For that purpose also you need some funds, although that may not be big or small, but you need money to work with the executives and other experts of the field. Now coming to the second thing, that is marketing. We say marketing. Can you think of any marketing activity which can be run without funds? No, we cannot think of, because marketing is such an important function of the business to improve its sales and all other things. You need to make expenses for selling, you need to make advertising expenses, and all those things, they are based on the finance. Now coming to accounting. Accounting is very narrow term. When we talk in terms of finance, accounting is, we are just counting again and again for what we all had done in the particular time period. So we are basically recording the finance, where it has gone and from where it has come in the accounting process also. Now coming to management. What is the job of the management? Management takes care of the whole business and it works only on the basis of figures. And from where does these figures come? Obviously all these figures, they come from the business itself, and business means nothing but running with the help of finance. So now we can talk about what is the scope of financial management. Financial management starts with the estimation of financial requirement, that is how much money will be required to do a particular business endeavor. Now we have decided that we need this much money. Now the second thing will come, now from where that money will be coming, whether we will be going for loan or we will be going for the owner's equity, whether it will be an individual owner or it will be going to be the shareholders. So we have to decide on the what is going to be our debt equity mix. Now we have decided the debt equity mix. Now even we want to decide further that what will be the main source of finance. Although it is debt, whether it will be debt by bank or it will be debt by debenture holders or by the financial institutions. On the other hand, if we are talking in terms of equity, so whether it will be which kind of equity shares or preference shares or it will be owner's equity, all that decision has to be made of. Now we had arranged for the money. Now we have to decide what is going to be our pattern of investment, that is in which pattern we are going to invest. Shall we invest the whole amount in the first year or in the later years, or how much amount will be required in the third, fourth and consecutive years. So all that things has to be taken care in terms of pattern of investment. Now we had arranged for the money, we had invested it money. Now we want to have the cash management, because we need money for day-to-day operations of the management, and cash also involve cash amount of money. We cannot say that cash is free. Cash means what all we have in the pocket. When we talk in terms of bank, in business, we need a lots and lots of money for the day-to-day operations of the business. Suppose we are in the nature of business which is of the seasonal nature. So in a particular season we need a lot and lots of cashes. Whereas on the other hand, when it will be receiving season, when the goods will be sold off, obviously we will be having extra cash. So we have to make a balance between the day when we are to invest cash in the business and the day when we are going to return back. Now the next thing is implementing financial control. We had procured the money, we had invested the money, we had managed our working capital. Now the thing is, we have to make control. Unless until you control something, it will be all going to the waste. So unless until a proper financial management control system is being followed in the organization, there will be extra expenses, there will be no control on the operations of the business, and everything will go, all the efforts will go in the vain. So the next thing, the important thing is the financial control, and that is the job of the financial top executives. Next is the proper use of surplus. Now we had utilized the money, we had invested it in the business. Now unless until we have utilized the surplus amount time to time, we cannot leave the surplus amount as it is in the bank or in the office lockers. We need to reinvest it for the even for the shorter time, like we give loan to the other people, or we invest it for some short-term projects, and all those things they has to be also taken care of. Now next thing is, what are the different financial decisions. Now as I have talked in terms of scope of the financial management, we had come to the conclusion that the main job of the financial decisions that come is, first one is the financing decision. That is, we talk about from where the fund was coming, that is how we are going to raise the funds. The second thing was investment decision, that is where we are going to invest in our organization and how we are going to get our returns. The third one is dividend decision. Now we had run our business with the help of available finance. Now we want to decide how much money has to be retained in the business and how much has to be paid back to the our investors. All that thing will be decided in terms of dividend decision. But last but not the least, the most important factor is the management of balancing between the cash inflows and outflows. To that, in terms of finance, we call the liquidity decision or the working capital decision. That is also an important part. Now coming to the first decision, that is investment decision. Now in the investment decision, it is a careful selection of the assets in which funds will be invested in the business. As soon as we decide to set up a business, we want which asset we have to invest in. For that, how much money will be required, whether we are going to buy the machinery or we are going to hold the funds, or we want to reduce the already existing machinery, or the replacement or selling or managing assets. All this come under the investment decision. The common question that are asked in terms of investment is in what line of business the firm shall engage in, whether we will be in a particular that long-term investments, or it will be a seasonal industry. All that thing has to be decided well in advance. Or should the firm acquire other company, or it is going to set up its own business from very crux. The next thing, what sort of property or plant equipment the company is going to hold, whether it should have a modernized machinery equipment, or it is going to sell the old production facility. All those decisions has to be taken in terms of investment decision, because on that basis only our investment will decide that how much money will be required. Next is, now we have decided where we are going to invest. Now how much money is required to work in those guidelines of the investment decision. That is, how much fund is required, that is from where we are going to raise the funds, how we are going to acquire those funds needed to support those long-term investments. That has to be very much taken care in terms of financial decisions. Obviously when we are talking in terms of various sources of finance, there are various positive and negative factors for that also. So we have to take care of them as well. Coming in terms of financial decisions, the finance manager has to decide what is going to be my debt equity mix, that is how much owner's fund will be invested in the business, or how much loan from the bank or other debenture holders has to be taken care of. The business can either finance from its shareholders fund, which can be subdivided into equity share capital or preference share capital, and the accumulated profit. Whereas borrowing from outsider includes borrowed fund like debentures and loan from a financial institution or loans from the banking institutions. All those has to be taken care in terms of financial decision. Now coming to the dividend decision, that is the third important decision of the financial management. That is this decision, it relates to the profit earned. That is how much profit has been earned in the business, whether that all shall be going to the shareholders or the owners in form of dividend, or the some part of it has to be retained in the business. This thing, how much dividend has to be distributed and how much has to be retained, it again depends on the various aspects of the business. That is that company whether it want to retain the same investment dividend policy for the future earnings. That is, what are the trends of the earning, whether the business is in the profits from last few years or it expect a future profit increase. In that case, it can decide on the dividend part in the way of trends. The second thing that comes is stability in dividend, because if the organization is giving 10% dividend in the current year, obviously the owners, they expect something more than in the next year. So if the company wants to at least maintain the same dividend, it has to be maintain a stability in the dividend. Next thing is the trends in the share market, because the business organization, their dividend decision affects a lot on the earning per share and the prices of the shares in the share market. So for deciding on that thing, company will have to decide that how much is the share price of the company in the market and how it is going to be affected by the dividends. If company declares more dividend, obviously the share prices in the market will go up. And does the company want that much increase in the market, or it want to have a long-term impact in the market? So all these things have to be taken care before deciding on the dividend. The next thing is to decide the requirement of funds for future growth. If the company is planning of high growth in the future, obviously it will like to retain more profits to its own as a retained earning instead of distributing it to the equity shareholders or the preference shareholders. So that thing has to be taken care of. Now the cash flow situation. Obviously dividend decision depends on the cash flow situation, because if dividend has to be distributed, it has to be paid in the form of cash or in the bonus share. So whether the dividend will be distributed in the form of cash or it will be distributed as dividend has to be taken care of by way of cash flow situation. If the company is having sufficient cash flow, obviously it will be ready to pay more dividend in the form of cash. Whereas if the company is having short of cash flow, obviously it cannot declare the dividend in form of cash because it don't have money to pay off. So it will be going for the bonus issue as a dividend issue. Next thing is the restriction on the part of Companies Act. Every country's Companies Act, they impose certain restriction in respect of payment of dividend to the owners. All that has to be taken care of before giving to the dividend on the deciding on the dividend. Obviously when the dividend is being paid, there must be some tax implication on the shareholders, because the dividend income, it is a tax payable income because it added to the income of the shareholders. So before deciding to the shareholders income, the company will have to decide how much money has to be paid in form of dividend, so that it don't create an extra burden on the owners of the or the shareholders of the company to pay in the form of the tax. That has to be taken care of. The last decision, that is comes in the working capital management. That is the money required for day-to-day operations of the business. That is called the working capital, as we discussed earlier. So whether the company want to, that again the working capital management, it depends on the nature of the business, size of the operations of the business, and the other important factors which we will be discussing in the later modules. So overall we can say wealth of the company is a function of our investment decision, financing decision, dividend decision, and the working capital decision. All they all together make the company's financial management thing. Now if we talk in terms of interrelationship between the investment, financial, dividend decisions. So first thing is, a company firm issues money security to raise the cash from the organization. Then it invests that money in the terms of assets in the business organization. Obviously when the assets has been invested, it operates and to generate cash flows. That is, when the business has been set up, the money has been arranged, obviously they want to have returns. That is, by the operation they want to have certain returns, so that we can say that yes, our setting up of the business has been set up successfully. Now it has been done, company has generated cash flow, obviously it has to pay taxes to the government, and after paying the taxes to the government, what all is left with the company, either it belongs to the stakeholders, so that we will be paying in the form of dividend, or it will be reinvested in the form of retained earning or plowed back into the firm for the growth of the business. And the next thing is cash is paid to the investors, that is who all has taken risk to invest in our company. Obviously certain amount of cash will be paid to the investors, either if they were debt then it will be paid in the form of interest, or it was owner's fund, obviously it will be paid in the form of the dividend. After paying dividend and all, the company will have to further go in terms of its growth. If the company is happy with all these things, it has to work with the financial managers, and for those financial managers, the financial manager's job increases with all those things, because the whole running of operations of the business, they depend on the finance manager.